Thank you for joining me tonight. I am Brandy Whitmire. I am a direct mortgage lender based out of Dallas, Texas. I am not only a direct lender, I'm a broker and banker as well, and we are nationwide. Today, I'm going to talk about something I talked about in the past, which is about credit. As you know, credit dictates a lot of things that we do in our life, whether we get an apartment, a home mortgage, a car, credit cards, anything, right? So it's important to know and understand credit. I believe this should be a class in our educational system, but it's very important that you know and understand credit. That way you can gauge and be appropriately allocating funds or opening accounts or not opening accounts in order to make sure that your credit score is high, because that's based, that's what you're judged off of whenever you go and you purchase something. Thank you, Autumn. So I want to touch on credit again. And today I looked to the help of my friend Billy Alt over at 700 Credit Repair. So I wanted to make sure that what I'm looking at as a mortgage lender is not the only thing that you would want to see, that you would want to talk about. So I pulled in my friend Billy Alt from 700 Credit Repair. He's awesome. We've worked with him. He's helped several of our clients in his company get some of our challenged credit reports up and where we needed to be. So I want to talk about this not only on a mortgage standpoint, but what if you want to go buy a car, or if you're not ready to buy, you're getting an apartment, or whatever the case may be. Just the general direction of what kills or what can affect your credit score. So I'm going to give you today 10 items or 10 top credit score killers. So number one, being current or delinquent on your accounts. So the worst thing you could ever have is an account showing delinquent or past due. So do whatever it takes to not allow any of your accounts to become delinquent. So pay that minimum payment, do whatever it takes. Don't let your payments ever go 30 days late, because the second that they go late, your credit score drops dramatically, and it takes a while. It takes months for it to creep back up back to where it was before you lost. And this can sometimes be anywhere from 10 to 50 points depending on the type of the account. Okay, so be current, don't go delinquent. Do whatever it takes to not become delinquent, because the amount of time it takes, it's too long, it's not worth it. The second item is a new public record. So let's say you got a judgment or a bankruptcy. Judgments, bankruptcies, tax liens, things like that, those go on to the part of the credit report that's called public record. So that can also dramatically decrease your credit score. So it's important to take care of those things. If you have a public record, if you have a judgment or some kind of delinquency on your account on your public record, go in there and see what it would take to get on a payment plan or get on something in order for it to show current or show as an actual account and get off of a public record. Number three would be a new 30-day late reporting to the bureau. So again, like going back to number one, being current and not going delinquent, being a new 30-day late is the biggest FICO killer there is. Again, so payments can drop dramatically. I personally had one 30-day late that dropped my delinquent account. It was an AT&T bill. I didn't have my address, and it dropped my score 150 points. It's for $100. And I couldn't have been more furious. But it took me forever to get that taken care of and to get that deleted, which, again, going to a credit repair agency, they can help you do those things, like my friends over at 700 Credit Repair. Number four would be a new collection or a charge-off. Again, talking about like that AT&T bill that hit me. It dropped my score dramatically. It took me forever to get that back up. So if you ever get a notice from a creditor about an open account in the mail or by phone, make sure you're working something out with them. Call them. Make sure they're not reporting that to the bureaus. and work and do whatever it takes to go on a payment plan, because most of these creditors and most of these companies want to work with you. So just answer the phone, try. If you don't have the money then, or whatever the case may be, at least work with them. Go on a $10 a month payment plan. I've seen people be on $1 a month payment plans just because these companies want to keep engaging with you. The companies or the these collection companies want to keep engagement with you. They want to keep communication with you. They want to talk to you. So as long as you're communicating with them, more than likely they're not going to put that onto your credit report. So just pick up the phone and at least try to work with them and make sure that these are not going onto your credit report. Number 5, dramatic increase in balances on your revolving credit. So revolving credit would be a credit card. So the highest credits people, the people with the highest credit scores are the ones that are not utilizing all of the credit that they could utilize. For example, let's say you have a credit card that has a $1,000 credit limit. If you're spending $10 a month on that, your score is going to be high. If you're utilizing $900, $950 of that, your credit score is going to dramatically drop, because you are using up all of the amount that you are able to borrow. So the way that the score works is the more that you use, the less your credit score is going to be, the more your credit score is going to drop. And even more than that, if you go over that balance, if you owe now $1,000 or $1,100, then your credit score is going to get hit dramatically because you're over utilization of the amount of credit that you can borrow. So the credit companies, the bureaus, the way that the FICO works is the less you use, the higher the score that you're going to have. That's why it's always important to do a 6-month or a yearly check-in with all of your creditors to see if you can get a higher balance. If you can get a higher, so let's say you have $1,000 limit, to increase that limit. So every 6 months to a year, call your creditors and say, hey, my rate is 25%, 19%, whatever it is in your credit card. My high line of credit is $1,000. Is there any way that I can get I'm calling in to see if I can get my rate reduced and to increase my line of credit. Doing that, first of all, you always want to shoot for a lower interest rate on these cards, because these are some of the highest interest that you're going to pay over anything that you pay for, whether it be mortgage, car, student loan, any kind of installment loan, credit cards. Your credit cards are going to be the highest interest rates that you're going to have typically on your credit report. So always call and try to get that reduced. They may or may not do it, but always call and get that increased line of credits. I do that every 6 months, and I've dramatically increased my line of credits, and my interest rates are low. They can change and they can revolve, but I keep on doing that over and over to save as much money as I can and keep my credit score high. And a good rule of thumb is to be at under 30%. It's not feasible to always keep it on, at 10%, because that's what your credit card is for. It's for emergency. It's to build credit. But a good rule of thumb is try to keep that under 30. If not, really try to keep that under 50% utilization. And number 6 would be new inquiries. So basically, that means opening too much credit too fast. The way that the FICO looks at it, if you're out and, I see this happening a lot with people who are buying homes because they go buy a new car, they got a raise or they got a new job. So they went and bought a new car, they are buying a house. So they went, and they're putting furniture on a credit card. They're opening a credit card to do this or that, the other. They're opening these, a Lowe's account because they want to do some work to the house. Well, opening all those different types of lines of credit at one time can dramatically drop your score. Number 7, limit your open accounts. Okay, so the credit, you have to have open accounts in order to create any kind of history. However, you don't want to have too many. Like oftentimes I see people, we tell people whenever they're first starting out to build credit, like go get a small credit card, go get a gas card, go get a JCPenney card, a retail card, go try to get a small credit card, because you want these lines of credit. However, people go overboard. I see people that have a Conn's, a Best Buy, a this, a that, Victoria's Secret, this, like all these crazy little credit cards, because they're trying to get 10% off that first sale or have, get on whatever deal. having too many of those open can dramatically drop your score as well. Okay, so, and then number 8, ReAging of negative debt. Okay, so FICO puts a major emphasis on the date an account went to delinquent. Okay, so as the diminishing older account, as the account goes on, so let's say you had an account that was closed and it went negative in 2015. As time goes on, the FICO is going to increase because the age of that delinquent account has passed. Okay, so the less it hurts your credit score. What collection companies can do is re-age that debt. So what that means is, rather than show that was opened, let's say 3 or 4 years ago, they change the date to a more recent date, so it appears to be a new negative account, which then drops your score again. So, you know, some people say, well, don't worry about that. I had that collection account was 5 years ago. In 2 years, it's going to drop off anyway. Well, as a collection agency, they can input the date, reopen that date, show it as new, and your 7 years starts back over. So just because you think that it's going to drop off doesn't mean it's going to. They can actually re-age that debt for you. Your credit score drops again, and now you're back to that first 7 years. So it's better to just call them, try to work out a plan, try to get the debt at 30 cents on the dollar. If you have $1,000 debt out there, call the credit agency and say, hey, I only have $300. I have it right now. Will you settle with me and be done with it, and have them delete it from your credit report as a part of the negotiation? That's the best thing that you can do. Okay. Number 9 is not having the proper credit mix. Okay, so FICO likes to see a smooth, even mixture of credit. So a healthy mix would be, let's say, like having 3 revolving cards. So that would be credit cards, 3 revolving cards. 1 installment loan, that could be a student loan or a car loan, any kind of installment loan like that, or a mortgage loan, and that's it. So you don't really want more than that. You know, it's not a bad thing to have more than that, but it just depends on how much you have. I mean, it's not necessary to have an 800 score, but having over 720 is really what I like to tell people the actual goal is. If you're over 720, you're pretty much good. You're going to get the best of the rates. You're going to get no one's going to look at you poorly. You're going to be in that good range. So mortgage loans are the best for your credit report, I will say. And, you know, again, keeping those revolving cards, try to keep them at 3 and try to keep them below that 30% utilization. And then number 10. Opening new accounts. So opening new accounts decreases your average account age on your report. So for example, I opened my first credit card in December of 1999. So if I were to close that account and open 3 new accounts within the last few years, the average age of my old account would be a few years and not divided out by since 1999, 19 years ago. So keeping older accounts is very good for you because FICO acknowledges how long your average account was open. So keeping it, so I'll never close that card. My 1999 card, I'll keep that forever. It's the first credit card I ever got. I'll keep it. Even if I don't use it, I'll put some gas on it every couple months, pay it off, and keep it, even if it's a higher, because the amount of time your accounts have been open, the average amount of time is going to positively affect your credit. So that are my 10 ways, or 10 ways you can affect your credit score. The top 10 credit score killers, as Billy Alt says it. So I want to thank Billy Alt and 700 Credit Repair for helping me put together a more diverse information. And I will be putting out a blog on this too on my LinkedIn profile, so make sure you're following us there. And make sure you are putting all of your information or any questions in the DM or in the comments, and I am happy to answer any questions that you have. We are always here for you. I hope to see you again next week, and let me know how I can help. Thanks.